Tax planning is tough when you're talking about in the course of an acquisition or business succession, because you're torn between two objectives. One is as John said right at the start, and as a view that I hold to, is that you can't let tax overtake the whole thing or become obsessed with it. Much as it kills me to say it, there are more things more important in the world than tax. It drives me insane, but it is true. Getting the best deal and figuring out what the best objective, the things that David and Peter have been talking about, is really the first driver for what you should do. Nonetheless, as John said right at the start, tax planning is critical. Before, during, after, throughout, it never goes away. Tax is ubiquitous. It's ever-changing and it's deeply entangling. And planning both leading up to a sale, during the course of the growth of the business, through every event that takes you through the particular business, including the disposition of the business and post-sale planning. Tax plays a part in every bit of it. So while you shouldn't have tax as the sole objective to crowd out every other idea, but at the same time, tax is so entwined anywhere that there's money that you have to have tax planning at all stages, not just as a particular event. What tax planning is trying to do is trying to get the best result for you at the lowest cost. Seems relatively simple to do. I was going to bring along an income tax act to use as a prop, but I didn't have a cart to bring it along in, so I wasn't able to do so. But it's a big, thick book. It keeps getting bigger and thicker every year. And the Department of Finance is full of very busy officials who are very, very clever and just want to cut down every bit of fun that we might want to have in terms of tax planning. The options have become substantially narrower over the course of the last few years. So one has to think very hard and strategically about where you can maximize the efficiency of tax utilization. I guess sort of two observations about what's gone on already. One, when you look at the case study, it's clear that not a ton of thought has gone into tax planning to set this structure up. People have set their business up and been very successful. And the three principals have been very successful at setting up their business, but they haven't thought a lot about planning and particularly setting themselves up for planning down the road. That's something that should probably change. The second, the heat map that you all did right at the start when Vanessa introduced it had tax planning at stage 6. You can only do so many things when you have a sequential map. You have to go one step after another. But I think but when I looked at that heat analysis, tax planning would be important at every stage of that. Different aspects of it, but there would be particular amounts. So to start from the very broad and move into the more particular, when you're thinking about selling a company or having an investment or getting out, there's two broad aspects that you have to think about. First, are you going to sell your shares or are you going to sell your assets? Each has a different effect. Vendors always want to sell shares. Why do they want to sell shares? Well, sometimes they can get their capital gains exemption. It's a better result if you're able to sell the shares, because if you sell corporate assets, there's always going to be a slight element of disintegration, which is what the tax people call it when you pay more than you would otherwise. When you've got a corporation involved, it's really, really tough to make a corporate sale and a subsequent distribution have the same amount of tax as if you sell something directly. So if you can sell shares directly, you never have to worry about that extra complication and the additional tax that will ultimately be payable. So vendors always want to sell shares. Also, if you have a company like the transportation company that's in the part of the case study that we're talking about, it's got a huge amount of depreciable property. That depreciable property is going to be written down to shelter income over the course of its life, which is a good thing. But that means that its value may well be in excess of what its depreciated cost is, which if it's sold, you have to pay back as income, recaptured income and paid back. One can avoid that by selling the company. On the other hand, purchasers, they want to be able to buy that shelter. Purchasers always want to be able to buy assets. Two principal reasons from a tax point of view is that, one, if you buy a company like this with a huge amount of depreciable property, You're able to use that cost in order to shelter future income. Sheltered income means more money for distributions, for internal growth, etc. It's a good deal for the purchaser. The other reason why you want to avoid buying a company as a purchaser is that you're buying all the problems and all the skeletons that the vendors might have. Due diligence can get you relatively comfortable that there's not some sort of terrible hidden disaster out there that you have no idea is coming, but you can never be sure. What if the vendor has done some particularly aggressive tax dodge sometime 2 or 3 years ago that you're unable to catch because it's not disclosed particularly well in the tax returns of the financial statements, and all of a sudden, after you buy the company a year later, there's an audit that starts, and the company is facing a huge tax bill. That's your problem. You have an indemnity from the vendor, but if the vendor has moved to Costa Rica in order to carry on their post-retirement life of surfing and living in a beach house, it may be awfully difficult in order to be able to get back at them. A share purchase is always going to be a bit more complicated and carry more risk than a straight asset purchase where you just buy the stuff. The tax results are often better too for the purchaser. So how do you bridge the divide? From the tax point of view, you look really to the price. A purchaser who would want to buy the transportation company says, geez, if I buy the assets, I'm going to be able to shelter some large amount of income every year. If I buy the shares, I'm not going to be able to do that. You, vendor, despite what you say when you look at how you might value your shares and you look at your multiples on your EBITDA, at the end of the day, I'm going to be sending more money to Ottawa by buying the shares than I would be if I was buying your assets. You have to compensate me for that. How do you compensate for that? I pay you less. I have to pay less up front, and that way I am compensated for the fact that I'm not going to be able to shelter ongoing income as much. So that can be a grind and a cost to the income. Again, in a company like this, it's far more pronounced than in another company where there may not be as much depreciable property or as much tax shelter that would be lost by an asset purchase. David, Peter, and John, or David and Peter in particular, talked about the potential conflicts that come between the shareholders and their objectives. And they really are a little bit torn because Frank wants out. He wants money in his jeans. Janet doesn't really know completely what she wants to do, but she does want to take some money off the table. And poor Olivier is really stuck because he both wants to grow the business and be able to get more money out of it. So he's really being pulled in both ways. That means that in any of the financing or any of the transactions that you're looking at, where is the money going to? Either debt or equity financing, is it going into the business and into the company to grow the business and take them out? Or is it simply going into the shareholders' pockets? That'll determine whether there's going to be an investment into the company by an outside party, whether by way of debt or equity, or whether it's going to be used directly to purchase shares from Janet and Frank and maybe from Olivier. Debt and equity then matter quite a bit. If it's debt financing, that's money that comes into the company. When the funds are in the company, they're used to take out the shareholder, there's a different tax treatment than if the shareholder simply sells to a third party. If the shareholder sells to a third party, whether it's a new purchaser or an equity financer, it's a sale of some shares. Those shares may or may not be eligible for the capital gains exemption, but they will definitely be a capital gain. Capital gain, only half of it's taxed, which means you have an effective tax rate of about 25% in British Columbia this year. If the money comes into the company as debt financing, though, and it's used to take out, say, Frank has his shares repurchased. The shares were issued a long, long time ago, presumably for next to nothing. And that means that all the money that Frank gets, instead of being a capital gain, is going to be deemed to be a dividend. Because money that comes out of a corporation it comes out as three ways from the tax point of view. It's either a contractual payment, like a salary, or a payment to a supplier. It's a return of capital, of which there isn't, and everything else is deemed to be a dividend. No matter how you dress it up, it gets deemed to be a dividend. So instead of being half included and taxed at about 25%, it comes out as a full dividend. It'll be taxed between 31 and 45%, depending on the tax accounts of the company. With this company, it maybe you'll be able to get a chunk of it at 31%, but a lot's probably going to be 44%. And that's on the full inclusion, not the half. Frank will be less happy. Also, no capital gains exemption. So how that financing comes in matters a lot if you're taking out particular people. It occurred to me when I looked at the planning, but that David and Peter didn't talk about, is whether there could be an internally generated buyout. What if they look around and they're not comfortable with bringing in another partner, because right now they've got a pretty good thing going, they've got the three of them, they like each other, they trust each other, and they're worried about the dynamic by bringing in either an equity partner or taking on a bunch of debt because of industry uncertainty. What if they decide, well, we're going to internally fund this? Is there some way that we can go about doing this with our own internally generated income? There they face, again, the conflict. If they redeem Frank's shares or redeem something from Janet, it's a dividend. But if they've got internally generated funds, how can they possibly use that in order to be able to get a capital gains solution for Frank? There's a tactic that gets used that's called a sidecar corporation. There's the general nomenclature for it. And it's a tactic that's used often to buy out employee shareholders. And so the company would incorporate either a sister company or a subsidiary company and use those in order to be able to buy Frank's shares. Frank is the main actor in this one. So internally generated funds could be used to buy shares from Frank in a way that gives Frank a capital gain rather than a deemed dividend. That way you don't have to give over the control that involves having a new and untested partner come in. We'll still be able to get a decent tax result for Frank on the other side. Another plan that they might use, say they decided to sell the whole thing. Somebody came and swooped in and then there was and made them an offer that they simply couldn't refuse. A plan that's going around that a lot of you will have heard about or will probably hear about if you talk to your tax advisors about selling gets generally called non-CCPC planning. And it sounds way more exotic than it is. If a corporation is selling something, and often shares, like Janet's, are held in a holding company, if a holding company sells shares, it's required to prepay some of its shareholder tax. You know all that refundable dividend tax on hand that you have to pay on your investment income and why your accountant tells you every year you have to pay dividends to recover the RDTOH? That's effectively a prepayment of shareholder tax. Because the way the income tax system works is that the Act says you can pay a flat rate on your business income at either 11 or 27%, depending on how much income you have. But on investment income, you have to pay a higher amount. You're paying close to 50%. The non-CCPC planning, as a way of selling, is designed to eliminate the refundable tax. It's not a savings overall, but it's a great deferral because instead of paying that tax now, you'll pay it down the road, and if the deal is big enough, that money may never come out and you may never have to do it. Technically, it's a relatively easy thing to do. The company has continued to somewhere exotic like the Cayman Islands, but it never really leaves Canada. It's always resident. It simply ceases to become a Canadian corporation, so it doesn't have to pay the refundable tax. So for Janet in our example, if she wanted to continue her holding company so that it wouldn't pay refundable tax, she would be able to sell either her shares or the building and reduce the tax rate on that by about half. To the extent those funds are being retained and reinvested in order to generate further cash flow that could be paid out to her, that could be a terrific solution. The capital gains exemption. Big question. Is it worth it? The capital gains exemption, when it came out, it's almost 30 years old, or maybe I guess it's a little older than 30 years now. It was a pretty big deal. and it was worth an awful lot of dough. It has become worth less over the course of time. You have to think about what it really is. The capital gains exemption this year is $866,912. In actual cash tax, $215,861. If you got a deal for $1 million or $2 million, that's a big number. If you got a deal for $50 million, that's the change that's behind the couch cushions in the grand scheme of things. It's one of those things that it's nice to get in the larger deals, and many of the deals are getting bigger and bigger. They're just eye-popping to my mind, but I grew up in East Burnaby and don't get out much. And but when you start getting to transactions of that size, then the focus on being able to achieve the capital gains exemption is kind of misplaced. You're better off getting a better deal and working your better deal, even if you have to pay the $200,000. And now we switch it back. I'll argue it to the other side of my mouth, which is that quite often with good planning, one has been able to set up a closely held company so that a trust owns the shares, so that you'll be able to get multiple capital gains exemptions on the sale of a company. So it's not just the founder or the founder and the founder's spouse. You know, it's the founder's spouse, and they're Mormons, so they have 37 descendants, all of whom are beneficiaries of the trust. That can be great fun. The government really doesn't like it, but so far, there's nothing that they've been able to do in order to be able to stop it, with one exception. Quite often in the course of a sale, when in order to be able to use a capital gains exemption, a bunch of excess assets have to be taken out of the company and paid up to a holding company as a part of the sale transaction so the shares will qualify. There's a real trap that's built into that, because if the payout of the excess assets in the sale happen in the same year, there's quite a fun debate going on right now about whether or not the payment of the intercorporate dividend will be tax deferred. The government has gone out and it's reassessed a bunch of companies for Part 4 tax at 38% on a pretty technical ground that I won't get into here. But suffice it to say that it looks as if some of these cases are going towards court, and really, when you get down to it, if you start fighting with the government, it's only fun for the lawyers. It's not fun for you guys. So you want to think and plan ahead and make sure that you're not caught in those sorts of traps. It doesn't stop when you have the particular transaction. You have to think about post-sale planning as well, and I know John's going to have quite a bit to say about that. But once you've had your liquidity event and you have all this money that's piled into the bank account, then you've got to think, how am I going to deal with that, both on a practical level and how can I most efficiently plan my affairs so that I won't be paying more tax than I might otherwise have to do. There's a variety of tactics that one can undertake. I mean, the obvious one for Janet is to freeze her estate and start paying that down so that there isn't a big, huge tax bill on her death, which is going to come sooner than those of others of her dependents. For Frank, he'll be able to take some of his money. He could lend it to his spouse and be able to avoid the income splitting tax. A spousal loan still isn't caught by the tax on split income. The tax on split income has been a huge game changer, and I'm not sure that everyone has completely appreciated or assimilated the difficulties and the expense that it's going to cause anyone who's trying to plan with post-sale wealth. It used to be that one was able to split it around among, children, grandchildren, various other descendants, elderly parents, the family dog, do whatever you could. But now it's severely limited. The basic rule is now you can't split income unless you can. And there's very, very limited areas where you can. Frank could possibly take account of one of them. There's one other step which is called surplus stripping. And it kind of got lost a little bit in the 2017 reforms because everybody was so mad about the changes to the small business deduction. But there are tactics which are very popular right now which convert corporate income that would otherwise be taxed as dividends to capital gains. A lot of people do them. A lot of accountants and financial advisors are promoting them. These are things that are in the government's headlights. There were rules proposed in 2017 that would have severely restricted dividend sprinkling, and actually out of that whole package in 2017, as a technical matter, rather than an ideological one, they were the only rules that made sense. Because they were the only rules that made sense, despite needing some technical work, but in terms of the overall policy of the act making sense, because they were the only ones that made sense, they were the ones that the government abandoned first. They will probably come back. No one knows when, no one knows how, but if any of the planning that you can take by being able to convert income to capital gains would be something that will probably apply now as opposed to longer term down the road.